What do you think is the biggest consumer trend to watch out this year?
You're seeing people like scale to millions of dollars of revenue quickly, figuring out like the TikTok algorithm. We kind of have gone through a couple of paradigm shifts in consumer technology. Like in the early 2000s, it was the internet, right? Like all of a sudden, all the stuff you were not flying was now on your computer. And now all of a sudden, the companies like Spotify or whatever that have really disrupted their respective industries are where there's consumer demand. Consumer demand that you honestly cannot ignore. Consumers really want to just stream music for $10 a month. That is going to happen.
Our guest today is Ishan Sinha, who is a partner on the investment team at Point72 Ventures, where he co-leads their consumer investment practice. Point72 Asset Management is an American hedge fund. It was founded in 2014 by Steve Cohen. Point72 Ventures is their venture capital arm. We discuss what types of consumer AI applications Ishan thinks will succeed versus ones that won't succeed, the challenges of AI media content and copyright, and we also talk a little bit about the music industry. Hello, I'm your host, Mike Gelb, and welcome to the Consumer VC, where we discuss the intersection of venture capital and consumer innovation. If you're enjoying the show, please subscribe on whichever channel you're listening on, whether that's YouTube, Spotify, Apple Podcasts. That would be amazing. And if you're loving the show and want the full experience, check out the newsletter at theconsumervc.com. I share fundraising updates weekly, and you'll be the first to receive new episodes straight to your inbox. All content and episodes are for informational and entertainment purposes only and is not investment advice. Without further ado, here's Ishan. So let's start from the very beginning of your career with Point72. I mean, Point72, why did it make sense in your mind for Point72 to even launch a venture fund in the beginning?
Yeah. So I joined Point72 in 2016, and I actually joined on the public market side, which is what Point72 is known for, right? It's a large asset manager. The bulk of what they do is publicly traded investing, which is a combination of both like fundamental long-short equity, like going long and shorting stocks based off of fundamental deep research, and a systematic like quantitative strategy, right? Quants and algorithmic trading and all that. So I was working on the fundamental side. I was researching stocks all day. It was an awesome job. You kind of just did research and read and learned about different industries all day. And honestly, like I was the first associate that they hired on the venture team. At the time, it was like, 3 folks in a basement in our old office. And it was really launched as like an experiment of like, hey, look, we have all these smart people at the firm, right? Doing research in different categories. We do have a large firm that, has ties to, in particular at the time, the financial services ecosystem, right? If you think about where Point72 sits, like, we work with all the banks, we work with all the lenders, like we're close to that ecosystem. And so Steve Cohen, who started Point72, had this idea of, well, can't we leverage the intellectual capital and kind of where we sit in the ecosystem to start making some startup investments? I think naturally we were seeing startups anyways. Like, you have to remember this was like kind of a different era in 2016 in New York City. It's not like there were tons of venture funds. And that was also, I joke about this, like in 2016, that was a time when like the idea of like a hedge fund doing some startup investments was somewhat novel. It's not really anymore. But, we kind of saw an opportunity. Hey, couldn't we come in here and like become like a real New York City venture fund? And we started doing fintech investing and then, sort of expanded from there. And yeah, one thing kind of led to another. The team just grew and grew and grew and started adding more verticals. And eventually we added a growth business. And yeah, now we're investing in a bunch of different spaces. I lead our consumer team. I do both early and growth stage on the consumer side. And yeah, honestly, it was kind of just, from my perspective, I just kind of lucked into this position. I was a hedge fund analyst. I think in 2016, I got bitten a little bit by the startup bug and kind of raised my hand. If you guys want to build a venture fund, I'll help you guys. I don't even know what that means, but I'll try my best to learn on the fly. And I don't know, like almost 10 years later, I'm still here.
No, I mean, congrats. What was the biggest transition going from public market investing in working at a hedge fund and then going into venture, into early stage and growth stage investing?
It's a really good question. A lot of people ask me this. I would say the core of it is that the two jobs are actually very similar, right? At the end of the day, you're looking at businesses and evaluating, is this a good business or not? On the public equity side, you kind of have the ability, if you don't think it's a good business, that there's another thing you can do. But at the end of the day, you're doing the same thing, right? You're doing research on trying to evaluate if a company is good or not. I'd say the thing that I really had to adjust to, it's two things, right? Number one, I come from a little bit more of a quantitative background. Like I studied economics in college and I was an investment banker before this. And so I was very comfortable making decisions off of data, off of like, you build a model and, the model spits out a number and you're like, oh, that's a good number. We should buy it. Right. And the reality is you can't really do that with startups, particularly like early stage startups. Maybe at the growth stage, you can do a little bit more of that. But I would actually like, it sounds fluffier, but I would actually say when you don't have the crux of like data to invest off of, it's
Yeah.
actually really hard, right? It's actually really hard to be like, I think there's something special about this human being, which is ultimately like what most early stage investing boils down to, right? Or it's really hard to think abstractly about markets. I always talk about like, you know, you can try to quantify the TAM for Uber in like 2007 or whatever, but like, what are you doing? Like what's the actual, like at the end you kind of have to like invest off of something abstract and invest off of a person. And I would argue that's way harder than like crunching numbers and like, oh, this data looks right. This trend line is up and to the right. That's the first thing. The second thing that I would say is like the biggest difference is the access piece of it. When you're a hedge fund analyst and you want to buy shares of a particular stock, like most cases, like if you have a view on it, like it's like buying those shares isn't the hard part. Whereas in venture, like the hard part I think is
Getting
like if there's a really
allocation.
good if you love a deal, chances are everyone else loves the deal too, right? And getting allocation is hard. And so like the interpersonal piece of it was an adjustment for me. I've grown to really, really, really love that. I mean, my favorite part of my day is spending time with founders, but like that was a trend. I did not appreciate that going into this job, how important that was. It might be the most important thing.
Do you think, yeah, so I guess that shift from being from really from being quant from really focused on the quant side to really not have enough data, I actually have to focus on the qualitative side and really build that trust with people, and actually you're really betting on the jockey in a lot of ways, especially in the early days, that than the horse, because the horse is still kind of assembling, it's still kind of growing into a horse. And so totally understand like that adjustment. I have a question. Just in your view, we talked about allocation can become hard in terms of competitive when the deal is competitive. Do you find when the deal is very competitive that actually translates into the company actually performing really well and maybe becoming quite a big company, or do you think that it actually doesn't have a lot of or actually being contrarian in that you actually looking at startups that maybe don't have that maybe aren't in that that it isn't actually as competitive to actually get in the rounds, that maybe is actually more enticing for you?
Yeah. The short answer is like I don't think there's a real pattern there so long as you develop the conviction internally as an investor. That's what I kind of always coach my team on, right? And I'll say this, like some of the best deals I've done in my career, like, now that I've been in it for almost a decade, and like we have realized a couple of exits and seen these companies grow. Some of the best deals I've done were super contrarian to the point that like there was no competing term sheet, right? Like to the point that like in investment committee meetings, I got asked like, are you sure about this? Like nobody else is looking at it, right? At the same time, for each one of those, like certainly we have companies where, it was competitive for good reason. The founder was amazing and they had a track record and, that company did well. But I would say there's sort of no correlation. I don't know if I would ever say like, just because a company's competitive means it's good, or just because a company's competitive means it's bad, like just because an allocation decision is competitive. But what I always coach my team on is, hey, if like you've done the work and you believe that this market exists and this founder is awesome, I don't care what other venture funds are saying. Like, let's do the deal, right? It almost like is an irrelevant signal for me.
What about price then? Let's say you love the company, but what what if how do you also stay price disciplined, for example?
Really hard. I mean, it's obviously easier in a scenario where, you are you can set the price, right? Because you're the only term sheet there. But
Right.
in a competitive round, it's tough. I think it just comes down to like, how much conviction do you have that this can be a big company, and are you okay paying up for it? I think I was listening to a podcast. I can't remember if it was this one, but with Sarah Toffel from Benchmark, who said, if the only reason you don't want to do a deal is the price, pay the price. Like if you have tons of conviction, and I couldn't agree with that more. If you have tons of conviction, you think this is going to be a Facebook like outcome or whatever, one of those companies, like, pay the price, but I would say, like, in general, I think given our DNA and how much time we spend on deep fundamental research and kind of the culture of our firm, we try to be as price disciplined as possible.
How and consumers never, well, not never, but it seems like for the last few years it hasn't been considered an attractive space to invest in, to spend time in. And I think that maybe in partly for good reason, in terms of everyone loves enterprise SaaS and or B2B SaaS in some way, shape, or fashion, in terms of obviously, like, the margin profiles, and as well as the overall customer base might be a bit easier to manage. Consumers are a bit more fickle, for example, than businesses, and maybe you have a lot more long-term contracts. But what do you think the pulse is right now when it comes to investing in consumer? And is it only is your only focus in consumer on the AI, in consumer AI, for example?
So you're right. Like, for the last couple years, it has not been the sexiest sector, I guess. And look, for good reason, right? Like, there was a wave of consumer companies that came out in the last decade that really were able to take advantage of digital marketing, right? The CAC game made sense. You could market on social media, on Instagram, Facebook, hit the right customer. Like, over time, those markets got crowded, and B, because of like Apple's IDFA rules and things that came out, like, suddenly that business model no longer really worked, right? And so I think that scared people off of consumer for good reason, right? Like, at the end of the day, unit economics end up being unsustainable. Like, what are we really building here? I think that's starting to change, right? I think investors are sort of realizing that. For one, there's new channels to go acquire customers, right? We're seeing that across our portfolio, particularly our early stage portfolio, which is like 0 to 1. Like, you're seeing people like scale to millions of dollars of revenue quickly by figuring out like the TikTok algorithm, right? It's so good if you want to get your profile, or you want to get your company in front of the right group of people. I don't know if you can scale to like $100 million business doing that, but like, you can prove product market fit pretty quickly. I think that's really interesting. I think investors are paying attention to that. And then I think the secondary thing, which you kind of touched on, is AI, right? I think we kind of have gone through a couple of paradigm shifts in consumer technology. Like, in the early 2000s, it was the internet, right? Like, all of a sudden, all the stuff you were reading offline was now on your computer. Then in 2009, 2010, like, that was when mobile powered by cloud became really ubiquitous. All of a sudden, you had supercomputers in your phone, and you had a bunch of apps you could use. And now all of a sudden, a lot of people believe that we're in sort of like the next wave of this, right? Where brand new experiences that consumers kind of hadn't even fathomed before are now available, right? Powered by AI. And I think a lot of people are really excited about that. I would say we've seen wave one of these companies sort of come and go, right? There's some that have obviously stuck around. ChatGPT and OpenAI is obviously the big one that people think of, but I'm really excited for wave two and the company sort of being built right now. And yeah, like, I wouldn't say it's entirely powered by AI, but I would say there's a lot of excitement about making sure that people are investing in the next wave of sort of great AI companies.
Totally. I mean, I'd love to talk, obviously, about this article that you put out about how AI media startups can help solve existential issues for the industry and artists. And when we think about industry and artists, we think about IP holders, right? And so what do you see as the most pressing challenges, the most pressing challenges for AI startups that can actually address this space, and talk about also some of like the problems that we're having right now when it comes to AI media startups, and actually some of these the actual publishers and the IP holders?
Yeah. So the genesis of like this article, the reason why I decided I want to kind of start thinking about this and write something here was because, Point72, we have access to a couple of different like interesting assets in the media and entertainment space, right? So the most obvious one, Steve Cohen, who founded Point72, also happens to own the New York Nets, right? And so we actually, go.
No, that's great. That's great.
We happen to collaborate pretty frequently with that team, and like that's kind of an interesting, like, we just kind of get to learn about like the traditional sort of sports ecosystem that way. The other interesting asset that we have is we were the first institutional check into this company called Range Media Partners, which is a talent management company in LA. They manage artists, musicians, actors, athletes, writers, digital creators. Obviously through that, they've started producing movies as well. They produced Long Legs earlier this year. We saw that. They also produced the new Timothy Chalamet movie about Bob Dylan. Forget the name of it.
That's right. That's right.
Forget the name of it. I probably should have watched it. But anyways, so through those two relationships, like, we've just been close to what I'll call like the traditional media ecosystem, right? Like traditional sports and traditional Hollywood. And through that, I've kind of gotten a pretty like front row view of how they've reacted to AI, right? And on the one hand, I think, I don't know, optimists about technology, probably like you and me, look at all this AI stuff in the market and we're like, wait, this is so cool. This is enabling new customer experiences. And on the other hand, in some of these meetings I'm sitting in, I'm hearing musicians say things like, well, this AI song I heard on X sounds a lot like my voice, right? And so like trying to straddle, like, I think I am a believer that this technology is here to stay. There are amazing things that it's enabling. I mean, it's, these AI music generators, like, you're democratizing something that has been really hard to learn for a long time. I think there's only good in that, right? But there's also, I think, a responsibility that these companies have that has perhaps gone maybe underappreciated by Silicon Valley and by some of these founders. And that's not to say it's wrong or, it's unfixable, but it's just something to be aware of, right? And what's interesting is, like, if you look at history, like, this is not the first time we've kind of gone through some of these paradigm changes. I mean, music streaming has a lot of parallels to this, and they were able to figure out a way to compensate the rights holders. Is it perfect? No, and I'm sure we'll get into that. But like, there's frameworks to work within, and so all this to say, like, when the lawsuit came out earlier this year about, or rather in 2024, about some of the record labels being a little bit upset with some of the AI music generators, it wasn't exactly a surprise to me. I think it will get figured out in due time, but I just think that's something that we as a firm are monitoring very closely.
Yeah, I mean, I feel like, because I know that you wrote about this in your article about saying, of course, there was, music piracy happening in the late 90s with of course the launch of Napster, and of course, I remember Kazaa and and LimeWire and a whole host of others where you can just download music illegally. And then obviously, Apple launches iTunes and kind of gets all the record labels on board for that. And it's because I think that the record labels thought, we can't live our lives just in lawsuits. This is what this is what consumers want, and it also just made the record labels look terrible. I remember Metallica just as well. I remember Metallica doing some of the lawsuits against their fans, and it was a really crappy era, I would say, for kind of all kind of parties involved. And at the same time, but the record labels, I think, needed to accept, we need to participate in digital, right? We need to participate in this world in digital music, not just physical music with CDs and records and tapes, but predominantly CDs, but we need to actually participate in this new digital era. How are we actually going to do it? Where we obviously protect our IP. I'd imagine, and then of course, Spotify comes along and, really, really almost has like an alternative to this existential threat, which is, piracy. But I don't know, for example, if Spotify was the first thing that kind of gets pitched to the record labels, they might, go, I don't know if they'd go, oh yeah, no, we're not going to do that. Why would we do that? Because our business model is so good. I mean, if you think about the record label's business model, it was unbelievable. I mean, you promote one song, you hope that song is a hit, and then you have a bundle of 10 to 15 songs or however many songs are on a CD. And then the only way the consumer can actually listen to that song apart from the radio is to actually purchase that music. So to purchase a full length album and pay, $20. And so, and even with iTunes, with like a paying $1 for a single, that's still really, really, that still is a huge disruption to the kind of bundled album previous business model that the record labels had. And now you're introducing, $10 a month, $15 a month to actually then have the entire catalog of everything being able, having the ability to stream songs. So it was almost like a compromise in some ways, right? In that we have this existential threat and piracy. Here's the compromise in the Spotifys and the Rhapsodies and the iTunes and stuff like that in order to participate in this digital in the digital world, because we have this consumer pull and there's no escaping this consumer pull for it. And I do wonder what that looks like when it comes to other sectors, because I think it's really, really hard. I think it's really hard. Like something that I've been thinking about, and certainly your article was what triggered it was, you mentioned how ChatGPT right now is facing a lawsuit with the New York Times, right? And they're using not just New York Times articles but other publishers as well, articles that they're using for and you search it and you don't know that it's from New York Times. You don't actually ever need to click to the website to New York Times or what have you, or to other publishers. And I remember going to a marketing conference back in, I think 2017, 2018, and Rand Fishkin, who is like a CEO, SEO and SEM legend, knows, really understands Google really well. And he's talking about how his biggest worry with SEO and SEM is that click-through rates are down, and that Google actually is emphasizing you wanting to stay on the platform than getting off the platform, which in some ways, yes, you maybe know who the article is from, but if you're not clicking to the article itself, right, then that does diminish what you actually created. No different to what ChatGPT is going to. So kind of this was a problem that was happening before even AI was introduced, right? And I don't know, there has to be some type of compromise that happens, but I'm not even too sure what that compromise, quite looks like in a lot of ways. Because AI or not AI, these types of things were happening previously.
I think that's right. Wow, so much there that I think is very critical.
Sorry, that was a long rant. Sorry,
no. I love that. I'm really good at this. So you're right that, like, if I can distill it down to one thing, I would say it's like the inevitability of consumer demand. Like if you read that article, I talk a lot about like the supply side and the demand side on the consumer, on these consumer companies, right? Like I feel like a lot of these AI companies right now, and I keep on bringing up the music companies, but that's just sort of the easiest example. I call them supply side companies, right? Where like you can go in there and you can create supply of more music. I think if you kind of look at history, like the companies like Spotify or whatever that have really disrupted their respective industries are where there's consumer demand that you honestly cannot ignore, which is why I call it like the inevitability of consumer demand. Because if consumers really want to just stream music for $10 a month, that is going to happen. right? Like regardless of what the record labels want to do, regardless of all your interests and your incentives,
well, it may not happen, right? It may not happen, but what's the alternative? The alternative is piracy,
it's
right?
piracy, right?
So that's the alternative. So we're going to introduce, $10 a month. That's kind of like the compromise per se with giving the consumers what they want, but at the same time still protecting IP.
100%.
IP
100%. No, that's right. And like, I'll give you a tactical example sort of in our portfolio. It has a lot of parallels to Spotify and a lot of the ideas that you're talking about. We have this company in our portfolio called Global Comics, right? With an X. They are, put very simply, Spotify, but for comics. It sounds like a very small market, but if you actually look at it, like there are 500 million comic book readers worldwide. Right now it's largely physical, but like you and I both know that's not really, how you and I both know like this is going to get Kindle-fied at some point, right?
Totally.
If you want to read this stuff digitally, you have to download DC Comics app and the Marvel Comics app and a Japanese manga app, and on the Japanese side the translations are all pirated, right? I'm a huge manga fan, and so like if you want to read stuff in real time, like when it comes out, you can either wait a couple weeks for the official translation, or there's like an ecosystem of people online that pirate stuff and translate it for you. Like there's a lot of like shady stuff happening in this industry, right? There's a lot of parallels to and then you can imagine when people are downloading PDFs and sharing them, and if you really want to find it, you can find it online, right? You can imagine the publishers are really upset about this, right? For every PDF that gets shared of a Spider-Man comic, like that's revenue that's lost, right? Or in Japan or in Korea for every for everything that gets illegally translated to the US and read on some user hosted website, like that's eyeballs that aren't coming to your website that you're not monetizing via ads, right? And so they're very upset about this. Their reaction has been for each of them to launch their own app, which is like a bad customer experience. So the founder of Global Comics, Chris Carter, he is actually a reformed pirate. He is one of the guys that like used to like translate stuff and put it on his own website. He had 100 million viewers on his website at one point, 100 million MAUs, and you can imagine the publishers weren't thrilled about that, asked them to stop doing it. So we decided to found the business legally. Now, this is a really good example of like the customer demand is unbelievable. Like it just for $10 a month, can you just get access to everything in a legal way? Yeah, 100%, right? Customers love that. The company is doing really well, but you can imagine like it's taking a lot of convincing to get the publishers on board. Or they're like, well, why would I do that? Why can't I charge $10 for my own app? Or, why can't I just do this my own app? I don't want there to be an intermediary between me and my consumers. And it's making me really appreciate 10, 15 years ago when Daniel Ek from Spotify went to the record labels, that must have been really hard. Like arguably harder than just building the technology. It must have been really hard to just get these like legacy institutions to agree to give you their IP. That's their whole business, right? You're transforming the whole business. And so the only reason that happened was because of your point around piracy was such a big deal. It was
what's the alternative, right? What's the alternative?
And the inevitability of consumers really want this stuff and they want it at a price that makes sense to them. And so it's interesting. I'm getting such an appreciation for how working with the IP ecosystem is hard, right? But on the flip side of that, like once you are Spotify, you get access to all the record labels content. And once you are Global Comics and you become the only place where people can read certain things they really want to read legally, that's a real moat, right? Like that's not something that can be disrupted. I think a lot, and maybe this is a separate tangent, I think a lot about over the holidays, I was playing around with Cursor and I was able to build I can't code. I was able to build my own little app in Cursor, and I was like, damn, like anyone can kind of build anything now, right? But you know what? Like IP can actually serve as a moat, right? Like it's not everyone can go get, Warner Music Group to give you access to their assets. And so I've been thinking a lot about those ideas, but yeah, it's hard. It's hard to navigate this ecosystem. It takes a special kind of founder. AI does play in this a lot, and I'm happy to go into that a little bit. But yeah, it's a hard endeavor, and I've gotten a great appreciation for what these entrepreneurs went through, Netflix and Spotify and whatever, like 10, 15 years ago.
Well, so do you think IP is a moat, or do you think that distribution's a moat? Because when you're able to distribute about it, like thinking about ChatGPT and they have however many 100 million or how many. I know that they're the quickest company to move past 100 million. I don't know what their user base is now, but you have all these users and everything like that, and Spotify as well could, I'm sure, make that pitch to the record labels that we've kind of that we have a really great grasp on demand, or that we have a lot of demand ourselves. How do you think about that tension between who has the actual power here when it comes to the distributors or the actual IP holders?
So it's really interesting, right? I think this is all changing in real time. Like I'm a very classically trained hedge fund investor, right? So we think a lot about moats and things like that. The reality is, again, I was playing around with Cursor over the holidays. I can kind of build whatever I want. I mean, I'm slightly exaggerating that point, but I can see a future where anyone can kind of build whatever they want, right? And so I don't even know what the concept of a moat is anymore, right? The only real moats I think are going to exist in the future are really customer love. It sounds so fluffy, but customer love, the community around your product, and probably some degree of proprietary IP that people can only access through you, right? I think historically distribution has been such a moat, and I think it's so incredibly important, but I don't know, what does distribution look like in 5 years when there's 3 million copycats of every app out there, right? I don't know. And maybe that's not the world, the way the world is moving in, but I can kind of see a reality where that's the case. And so, I don't know. There's a very short answer to your question. If you look at history, right? You look at Spotify, I attended their investor day in 20, I think it was 2018 when they did their direct listing. At the time, right? This was such a big debate in that stock where Spotify gets all their content from now it's changing, but at the time, largely 3 record labels, right? They had 3 main suppliers. And there was such a big debate on, okay, well, who really controls this dynamic? Is it the label? Is it the distributor, which is Spotify? Obviously, the people that were very long Spotify were arguing that Spotify was going to do that, was going to control these negotiations. Because, for every $10 you spend on Spotify, labels get a portion of it, Spotify gets a portion of it. I think what history has shown is actually the IP holders hold a little bit more power in this. Their gross margin hasn't materially changed in the last couple of years. They're still paying $7 to $8 of that 10 out to the labels. And, that hasn't really changed. Now, there's so much interesting stuff to talk about here. You look at what's happening with music and AI right now, right? Anyone can generate anything that they want. That's kind of, I've been thinking about this for a while. That's kind of in Spotify's interests, right? If you can dilute the power of these labels, if more people are generating more songs outside of this label oligopoly, outside of this ecosystem, that kind of reduces the supplier concentration. I think a bunch of things I think are changing.
Yeah, I think as well. This is why Spotify got into podcasting too, right? And why 100%. They had to double down on podcasting, because as well for them, podcasting I'm sure is a great business in that you don't have to pay any of your margin to the record labels or to podcasters. You don't have to pay them to anybody. No podcasters have to. There's no royalty for podcasting. So that's why. Do you think that there should be a royalty for podcasting?
It's a good question. I guess I don't necessarily see how it's different for music, right? At the end of the day, the argument for the sort of business model of record labels was, hey, they used to cost a lot of money to go buy a guitar, rent a studio, get a microphone, whatever, right? And record your song and hire a band, and I'm not going to say that's not expensive anymore, but theoretically,
it's certainly come down in price for sure.
Come down, right? And so I don't see why record labels why podcasts are different, because there's still expenses to the microphone in front of your face right now. The tooling you need, perhaps getting the right guests on board, and so I can see why those business models have parallels and are similar, and I can see why there might need to be an entity in the middle of the podcaster and a Spotify that handles the financing of it and gets royalties paid out. But I get why Spotify is doing what they. I mean, it's exactly what you said, right? They're trying very hard not to pay 80 cents on the dollar.
Yeah, no, for sure. I don't know if podcasters really should get royalty, because I'm thinking that, I think part of the difference is I'm thinking about, how podcasters make money and how, musicians or, record labels and everything like that makes money. A lot of the money that record labels make, or some of the money that record label might make is, of course, on the actual royalty on music itself. And I mean, because those royalties now are really crippled compared to what they were previously getting in the CD era, they've now actually had resort, of course, like 360 deals and all these things to get their money from other ways, pretty much have like a percentage of sales from the artist for everything that they do. Doesn't happen all the time, but it certainly was something that was, is fairly controversial. But in the podcasting side, the one thing you can do in a podcast that you can't do in music is actually display like an ad for it, right?
Yeah,
or you actually can do. So there's a ways to, within the content itself, there's actually ways to actually make money within the content itself that you're actually listening to, right? So, and then of course sell that to potential sponsors, and then also, and you can't really do that in music, right? So I do think it's interesting, because I think that if there was royalties within podcasts, that could change as well some of the dynamics for podcasting. Meaning, would you sign exclusive deals with Spotify to stay on Spotify? Well, maybe you actually want then your podcast to be distributed as big as possible and have the largest distribution network as possible, because then it's more royalty that you're getting. Now, that royalty probably is still pretty small in terms of what you're getting from a listener perspective, but that's why I don't think, well, maybe one of the reasons why an artist will never go exclusive to a specific platform in terms of, hey, we're only going to be a Spotify artist, for example. I don't think that's why an artist would ever do that. And also where an artist makes the majority of their money is, in touring. So you want the widest spread as possible, the widest accessibility, in order for someone to find out about you and to obviously go see you on tour. So, but it is interesting. Like, it is interesting why about, royalties and podcasting, and if that even makes sense.
Yeah, I think the economics of, like, you're right. Like podcast ad, this better than me, but podcast ad economics are supposed to be quite good, right? Like, people actually listen to those ads, and there's like decent monetization off the back of that. But you're right, like, that kind of is offset by the fact that there aren't like sync licensing opportunities, right, with podcasts. Like, if you're a musician,
you're right. You're right. No, that's
fair.
fair. That's a fair point. That's a fair point.
Wow. It's interesting. It's a very interesting thing about it.
Yeah. How also do you think around, I think this is in the article about how, you talked about, I'm just thinking as well on publishers on the publishing side, and maybe going back to ChatGPT and Google, right? And Google kind of wants you to remain on the platform and not actually click the links. And as well as ChatGPT, there are no links. You're just giving the information, and you're not actually too sure where that source is from, but it's in their data set, and the data set might include, the New York Times, for example, right? But what do you think is the right way or theories to kind of have this compromise that we experience in music? I kind of call it a compromise, or the worst of it, which is piracy, right? Yeah. What's a way to kind of combat that when it comes to actually publishing itself in this new AI world?
Yeah, I mean, look, I think there are a bunch of approaches in the market, right? I think there are projects out there like Nightshade, which are explicitly trying to like block the scraping of written work for AI models, right? Like, I don't know if that's the best way to approach it either, only because, like, again, like, people are going to figure out ways around it. I do think the licensing opportunity, like, I think OpenAI is doing a lot of the right things on that, right? Like, I think they're going and they're striking deals and trying to compensate the writers and these outlets to get access to the platforms. I think I'm starting to see this now more in ChatGPT when I use it. They are starting to link to external references, and like, I think the more they build that in there, I think Perplexity was already doing that as well. Like, I think that's good. Like giving credit and being like, hey, if you want to read more, click here. But it's a really hard problem to solve.
Yeah, I mean, do you think like so in the music industry, of course, you have like a high concentration where I think it's now there's been a lot of consolidation, but I think there's now 3 or 4. EMI, I think, is still independent, if I'm not mistaken.
Yeah.
But so you have the big 4 right now, but of course you have like a very kind of high concentration of music artists, and of course there's a ton as well of independent artists. And then on the publishing side, you have ASCAP, BMI, and
Yep.
CSAC, and all those taking care of the publishing rights. Do you think that maybe there should be some sort of like publishing organizations that actually represents a lot of these groups in terms of like and actually the New York Times and Washington Post, but also just really just like publishers in general in terms of actually to then have even more power versus some of these AI platforms to actually consolidate that? Do you think that something like that could be in the works?
Totally, right? Like I don't have any knowledge if it's in the works, but like I do think that's a big part of the power dynamic in the music industry, right? Like again, it's changing as like more artists go independent, and the growth of like Merlin and some of these like more independent outlets. But like historically, the music industry has really been run by 3 record labels: Sony, Warner, and Universal. And there is when there are few suppliers, right? Like there's a lot of collective bargaining power that they have, and I mean, I think the lawsuit against Suno and Udio was through the RIAA, which is representing all 3 of them, right? And so, like, I don't know. I think that's a very powerful statement that will get a company to sort of act on it. And like, I don't think such a sort of agreement exists amongst like written publishers, like written publications. But I definitely think it would help them negotiate and leverage, right?
Totally. Also, in your switching gears a little bit as well, you also mentioned in your article how you feel like when you're looking at new AI concepts, it maybe just doesn't. It's not really solving a problem, right? It's just like a fun thing to kind of do and exercise, but it's not really quite solving a problem. Maybe you're creating a cool image, or maybe it's a short video, but it's not really solving a problem. There's this. I'm just curious what you think about this. And I think that quite a few people, including Chris Dixon, kind of talks about this a lot with Clay Christensen's disruption theory, and point to kind of the next big thing will look like a toy. Yeah. Do you think that this will be the case in AI? The next thing the next big thing will actually look like a toy, and something that right now you actually don't think is a immediate solving a problem or is an immediate need that could one day become in it, or do you think, or do you not think so?
I try not to be like as black and white on that stuff. I think, look, my preference as an investor is definitely to start with demand, right? With like, do people want this? Is like the fundamental first thing I ask. And I think maybe perhaps my risk profile as an investor is I don't love investments where I have to hope that one day collective behavior changes and people want it. I don't know. That's just the first thing I asked. You're totally right that like, companies like, I don't know, I remember in 2011 or 2012 when I was in college, like Snapchat came out, it felt like a toy, and I didn't know that it was going to be this like massive generational company, a decade later, but I get it. I totally get that thesis, right? I think from my perspective, I think companies, I mean, look, we come from like a sort of, we operate within a hedge fund where we think a lot about, for all of our investments, we really critically think about and often do like model out the future, right? Even for our early stage companies. And a lot of that boils down to like, can we really articulate customer demand here? Do we think there's a path to sort of sustainable unit economics? Is there all the boring stuff? Is there a path to like significant free cash flow generation? Like how so? What do we have to believe? And I think that often starts with, do we believe people are going to use this product and why, and is that going to sustain? And I think that informs like the sort of toy comment, right? Where like, I think for me, I'm kind of always looking for businesses where there's clear and articulated customer demand, and like we always start with that.
How in terms of customer demand, what are some maybe metrics or things that you focus on that actually validate if there is customer demand?
I would say all the usual, like no big secrets here, right? From like a consumer perspective, I mean, we're obviously looking at like the sort of top line metrics, right? Like, is this thing growing? Like, can I see that there's some degree of people are using it and they're telling their friends about it. I want to see reasonable CAC, right? Like, do you have to spend tons of money to get people to open your app and use it and pay for your product? And then obviously the most important thing, retention, right? Like, do people love this? How often, like engagement, how often are they opening up the app? How often how much are you retaining your paid customers? If there's a free tier, how much are you retaining them? Like, how does that look relative to benchmarks? How much time are people spending within the app? I think those are all, I wish I could say there was some like formula that we put all the stuff into a model and it spits out a yes, invest button and click invest. But yeah, we kind of look at all these things and try to approximate. We're honestly trying to answer the question of, do people like this, and do we think they will continue to like this in the future?
If you don't mind, I would love to do a lightning round with you, if that's all right.
Sure.
All right, cool. So what do you think is the biggest consumer trend to watch out this year?
AI agents. I think this is the year where like consumer-facing AI agents are, in my opinion, going to get really good and are going to start doing tasks for you. I have a lot of questions around, the defensibility of a lot of these companies, but as a consumer, I'm really excited for people to, start taking away some of my mundane tasks.
When, in terms of tasks, what if you wouldn't mind giving an example in terms of what tasks you think some of these agents will be able to do?
So we've spent a bunch of time in the last year in the travel space, right? And I would say a lot of the sort of consumer-facing travel companies, which are all really cool, were ultimately discovery focused, right? It was like, hey, like, here's type in like the approximate, like I want to go on a beach vacation and this is my budget and here's like 10 options and here's pictures and videos of it. Like, I think that's really cool. I think ultimately why we couldn't get there on a lot of them was they didn't actually lead to anything. Like, turns out the friction point wasn't really in discovery and daydreaming. It was actually in like, all right, I want to go to Kenya, which is where I went on a honeymoon. Like, that's a really hard trip to sort of plan out. Like, like you got to book flights, you got to get visas, you got to book the safari, you got to get the car from this airport to that airport. Like, can someone just do that for me? Right? Like, can like, I don't want to pay an actual travel agent, like whatever, hundreds of dollars. Like, can an AI agent actually do that for me? I actually met one recently that, I would say got like 80% of it. It was really cool. Right. And so I think things like that, where you're not even expecting it, right? I spent time with, again, like the tech wasn't there yet last year, but I spent time with an agent. I keep saying someone. It's probably Freudy. With an agent that was automating a lot of like home care tasks, right? Like I'm currently dealing with a broken microwave. Like, what if I could just, I don't know, text an agent, can you just deal with this, right? And they would interface with the person to come into my apartment and fix that up. I think the tech is finally getting there this year. And I think because the tech is getting there and is getting less abstracted, more like consumer DNA founders can start to pick up some of this technology and actually build something great for the consumer versus like what often feels like science projects. And so, long way to say, I think this is a year where like a lot of these companies are going to come to market, and I think it's going to be a net positive for the consumer.
That's awesome. Thanks so much for giving us that use case. Within venture, what's the biggest thing you've changed your mind about?
Wow, that's a really good question. I would say, the biggest thing I think I've changed my mind about is now that I've been investing in venture for sort of, call it 8 or so 9 years. I've kind of lived through like, and granted, that's not a very long career relative to a lot of people in venture. But I've kind of lived through like a couple of different sort of market cycles, right? Like when I joined in 2016, that was when that was at the tail end of like a lot of the D2C companies raising a bunch of money. Then that kind of stopped being hot, and then fintech became a big thing, and B2B software became a big thing, and then that kind of tailed off, and then crypto became a big thing, and then that tailed off, and then AI became a big thing, and you could argue it's starting to sort of tail off right now, perhaps not as dramatic, but you could argue like the fervor slightly dying down. And so like I think the biggest thing I used to, when I was younger, try to play into those trends a little bit, like, hey, we should be looking at crypto right now, and it's like, and I would say that around like 2019, 2020, and I think the only thing that you can really do is like just think a little bit ahead, invest in great founders, and make sure that the business model is sustainable, that it can live through these like the troughs where like capital isn't quite as easy to access. And I think that's all you can do. It sounds so simple. Bet on good founders that are solving real problems, that think about capital efficiency. It sounds so obvious, but I don't know. I guess I didn't really appreciate that as much when I was a little bit younger. And so that's all you can do. Ignore the market cycles and just bet on good people.
Love that. So this is based on, I believe it's based on Sarah Tavel's kind of framework in terms of all the different kind of 5 elements a venture investor needs to do and be great at, or at least focus on. Sourcing companies, picking the right companies, gain internal approval to invest in a company, negotiating a term sheet, and then advising or working with portfolio companies. What do you think you're best at of the 5, and what do you think you have most to learn?
So with sourcing companies,
picking, getting internal approval to invest in a company. So like, and then negotiating a term sheet, and then advising and working with the portfolio companies.
So, okay. So I would say what I'm best at, and I'll almost like take this one out, is getting internal approval, only because like I have such a good team around me. I have so much support. I have so many people that like kind of just have faith in me that like I can invest in a manga comic book company and people are like, we trust you. Right. And so like I would say like if I get to conviction on something, I feel pretty good that like I have the right people around me to put me in a position to succeed there. I think so. I'll take that one out almost. I would say I think where I am really good, where when I've done a retroactive, it's in picking. Like I'm a hedge fund analyst by DNA. I'm a stock picker by DNA, and we've done retros. There are very few deals that I've missed. Like in terms of like companies that like I've met where I've been like, I don't know about that. Let's not go further. No, that doesn't make any sense. Now, like, do we win all of those? No. And then do we see every great deal? Certainly no. But I did, like, as I've gone through like my list of like, oh, I met that founder for the first time, and then that turned out to be this $10 billion company, and I totally didn't see that in the first meeting. But that almost never happens, right? So I think I have a good eye for that. I think flip side of that is, we don't see everything. I do think there is, my team is based in New York City. I do think there's an advantage to being in the Bay Area. I'm in the Bay right now. But like we definitely are not seeing everything, right? And like I would say on the sourcing side, we are good, but we're not great, right? I would say that's the part where I'd like to improve the most.
For companies that you don't win, what do you think tends to be the reason why you don't win the deal?
Almost always it's brand, right? Like Point72, I would say has a good brand, but I would say we have a really good brand in New York. We have a really good brand if people know the hedge fund, they know of Steve Cohen, they know of the Mets story, but often like founders want to work with, the tier 1 Silicon Valley firm. And I get why. There's great signaling to that. It does certainly help in recruiting to be able to say that you had XYZ great, storied Silicon Valley firm. I think we're still a relatively young firm, right? On the venture side. And so we haven't built the same brand as a couple of these others, but that's almost always the reason why we lose deals. And hey, like that is that's a part of the game.
Totally. My final question for you is, what's one book that's inspired you personally and one book that's inspired you professionally?
One book that's inspired me professionally is a book I actually read it a couple of years ago and I'm rereading it now, called The Adaptive Markets Hypothesis. It's written by an MIT professor, Andrew Lowe, and it's basically about the efficient markets hypothesis and how it's almost like just accepted as truth, right? Like stocks trade at a value that takes into account all information available, but then how can that also be true? How can it also be true that stocks are mispriced, right? Like how can those two ideas both be true? That like things are efficient and there's value to be captured, right? And he creates a really cool framework using ecology and psychology to sort of explain the gap behind it. And it's a fascinating book that certainly informed my way of thinking, particularly as I transitioned from the hedge fund side, where you think so much about the efficient markets hypothesis, to the venture world, where frankly nothing is efficient. And so like it was a very cool read. In terms of like a book that has that's really sort of affecting me personally, that I just love. Another book that I recently reread this summer. I was on vacation in Sardinia with my wife in the Mediterranean, and I reread The Count of Monte Cristo. A movie just came out on it, which I also recently watched, and it was awesome. But The Count of Monte Cristo, one of my favorite books I ever read. The ultimate like adventure story, the ultimate like revenge story, and like I don't want to spoil it, but I feel like the ending is great for people that are maybe insane and too committed to the work. And the ending is kind of just like, chill out a little bit. If I can spoil it without spoiling it. And I love that book. And so it was very fun to like read it while we were like on vacation for that week in the Mediterranean. Like, oh, I recognize that name. Would highly recommend a reread of it.
Yeah, I never read Count of Monte Cristo, which certainly was a mistake. But I saw that. I know there's one that came out last year, but there was one that came out like 20 years ago, right?
There was one that came out 20 years ago, which was great. And then
I love that one. Oh my gosh. Like that was like one of my favorite movies growing up, which so in hindsight should have also read the book, but
you'll love the new one. Movie. The new one came out and it's in French. Like I don't speak French. I have to watch it.
Okay.
But it got like you can look this up. It got like an 11-minute standing ovation at the Cannes Film Festival because it was just that good. So I watched it and it was amazing. It was I think it like just came out in theaters like I want to say a couple weeks ago. So it's I would highly recommend it.
Yeah, 2002. That was the one version that I must have watched. Awesome. I will definitely have to check out the French one that just came out. Ishan, this was awesome. Thank you so much for coming on the show. Thank you so much for spending time with me. I really appreciate it.
Of course. Thank you. Stay safe in LA, man. Hope the family's good. Man. And hopefully all's good. I appreciate you having me on.